Wednesday's inflation data came in at 2.9%, and that's the lowest level since 2021, which left most people optimistic that a soft landing was coming. However, we zoom out and combine this new inflation data with the recent unemployment figures, then we see that our current situation is very much like what happened back in the summer of 2007. And as you may recall, we were not in store for a soft landing at that point. So specifically, the recent unemployment announcement, the official numbers were 4.3%, the highest level in almost 2 years. And the reason that caused such turmoil in the markets is that triggered the so-called SOM rule. So this is named after Claudia Somm, and in her research, she found that when the 3-month moving average of the U.S. unemployment rate rises by 0.5% or more above its prior 12-month low, then that means a recession is underway. Okay, and so that particular rule of thumb or association has been true at least going back to 1970. And so again, the most recent announcement of the official unemployment rate did trigger the so-called SOM rule, and that combined with actions of the Japanese central bank and so on, I think contributed to the turmoil that we've recently seen in the markets with VIX skyrocketing and so forth. So while most commentators, I think, are very confused and they're seeming to get cross readings and not understanding, well, gee, by some measures, seems like we're in store for a soft landing, and others, what I've been saying, at least since April here at Infineo, is that no, if you just look at the overall unemployment and inflation data, this is exactly similar to the pattern we saw back in the summer of 2007. So this graph is showing the unemployment rate, that's the red line, versus the effective federal funds rate, which is the blue line. So that blue line is like the Fed's policy rate. When they say, oh, is the Fed going to hike or is it going to stay pat? They're talking about that blue line. And so the first yellow arrow is pointing to the period right before the financial crisis set in. And so you can see, remember, this was like the midst of the housing bubble years, and the Fed from, I think, June of 2004 going forward, every time they met, they hiked interest rates 25 basis points. And they were trying to achieve back then a so-called soft landing to get out of the housing bubble, to take the gas out of the housing market, because everybody knew, well, these double-digit annual increases in home prices isn't sustainable. And so the Fed was trying to take its foot off the gas, but without causing a crash. Okay, so that's what they were doing back then. And so you can see they eventually stabilized, and interest rates were like 5.25, something like that. Right, so it was very similar to what happened this cycle. And so if you just kind of look forward to that second yellow arrow, you can see what I'm talking about. All right. And then also, but look at what the unemployment rate was doing at that time. So that's the red line. So you see back in that original episode, right before the financial crisis, that the unemployment rate, even after the Fed stabilized and just held rates steady, the unemployment rate still kept trending down. And then only, let's see, it wasn't until August of 2007 that the Fed started cutting rates back then. All right, they had held them there steady. And so if you look at the length of time that the Fed back then in that cycle held rates steady, after they had steadily but slowly marched them upward, and then they were holding them flat, the unemployment rate kept trending down, then it troughed, then it started going gently back up, and then the Fed started cutting. I'm saying the timing of all that, which was consistent with what was going to happen right before the worst financial crisis since the Great Depression on a global scale, that is exactly the same pattern this time around. Right. So all these people that were saying that, as of back in April, that's when I made this chart and I was showing this. Back in April, everyone was like, oh yeah, we definitely got a soft landing. Look at all these Chicken Littles running around saying, oh, the Fed hiking interest rate is going to cause a crash. Well, surely we would have seen the crash by now. Duh. We've been holding rates steady for a long time. Unemployment isn't zooming through the roof, so I guess we're out of the woods, right? And my point was no, because if using those arguments, all of that would have been true back, as of April of 2007. And as we've seen back then, the Fed held steady through May, June, July, and then they didn't start cutting until August. And so what that led me to say here is, see how similar that situation is to our current one. The Fed stopped hiking rates in July 2023, when the effective federal funds rate was 5.33%. It has held them there since, while the unemployment rate troughed and is slowly drifting back up. This is what I was writing in April 2024. What's the takeaway? Even if the Fed holds rates steady through May, June, and July, it would be perfectly consistent with what happened going into the global financial crisis. So therefore, the bulls shouldn't be running victory laps early this summer merely because the Fed sees no immediate reason to cut. The inverted yield curve still looks like a good indicator, and I think it's still flashing danger. Will Robinson. All right, so again, the takeaway was, I wrote back in April, even if the Fed does not cut all the way through July, that is still consistent with what happened last time when we were going into the financial crisis. All right. By the way, the financial crisis was 2008. Okay, so I'm saying the Fed started cutting and then unemployment started rapidly rising, not until late summer, fall of 2007. The recession is officially said to have begun, I think, in December of 2007. And then it was the following fall in 2008 when there was like the AIG crisis and everything. And that's when, people said the global financial crisis hit. Okay, so for example, if the Fed calls an emergency session at some point in August and starts cutting interest rates, then the pattern will be literally the same, like the exact timing down to the month of when they started cutting for this cycle. So I'm not saying that's necessarily going to happen, but my overall point was all these people thinking, well, surely if the inflation of the COVID era and then the Fed rapidly hiking rates and letting its balance sheet shrink in order to nip that inflation in the bud, if that was going to cause a crash, we would have seen it by now. And my point was, no, if you think the financial crisis had something to do with the housing bubble, right? If you just, there's some economists out there who think the financial crisis was an unforced error. That was just, the Fed over tightened because of the rise of, the high oil prices in the summer of 2008. And that didn't need to happen. But I think a lot of economists, and then more generally, a lot of intelligent people in the markets think that no, there was loose monetary policy and other bad policies, lax credit standards and whatnot. Both public and private decision makers made mistakes during the housing bubble years. That profligacy kind of set us up for a crash that then hit and really manifested itself in the fall of 2008. So I'm saying if that was what you think happened then, we're right on track for a similar thing happening this time. And again, I think as a feather in my cap for my perspective is that I wrote back in April saying, no, everything might seem fine even all the way through July. And that's consistent with what happened last time. Okay, more general, let me just remind you what's the story with the yield curve. Here's a chart of what that looks like right now. So you can see historically what that blue line is representing is the difference, the 10-year yield minus the 3-month yield. That's the best predictor. Some people look at the 2-year versus the 10-year, but the research shows it's actually the 10-year and the 3-month that has the most predictive power, has the best track record, if you will. So if you just go to the Fred website, that's St. Louis Fed's website, it's real easy. That's one of the data series as they do it for you, the 10-year constant maturity yield minus the 3-month Treasury constant maturity. And it shows that. And then they also graph it with those gray bars showing when the recessions were. And so it's a real easy tool to use. And you can see the blue line goes negative, right? Goes below that zero horizontal line shortly before all of those gray bars. And that pattern actually holds up back to the 60s. There's like one, what would you say, false positive, where there was an inverted yield curve and there wasn't an official recession, but even there, it was like there was a GDP growth slowdown for 2 quarters or something that wasn't technically considered a recession. Okay, so I think no false negatives, right? So any recession that actually happened, there was always a preceding and recent yield curve inversion since at least the 60s, and one false positive that actually was barely false, if you get what I'm saying. Okay, so as you can still see now from the same chart, in recent times, the yield curve has been very negative, far more than you can see in the sample we're looking at here, in terms of how negative it went, meaning how much higher the yield on the 3-month was compared to the yield on the 10-year. That's what it means to be negative. So people like me have been saying for years at this point, like, there's a recession baked into the cake at this point. We weren't merely looking at the inverted yield curve, but that was a signature telltale sign that complemented our qualitative analysis about what the Fed had been doing and so on. All right. And so the problem is it has just stayed inverted, right? You can see it's not merely the vertical drop, like how deep in the negative region it's been pushed, but for how long it's hung out there, right? If you look at those prior episodes, the blue line just pokes below that black horizontal line for a little bit and then pops right back up. And then a little bit later, the recession kicks in. So this pattern right now actually isn't contradicting that, right? Because the pattern has not really just been, once the yield curve inverts, then soon after there's a recession. Really, the pattern is once the yield curve inverts and then uninverts, right? Goes back to an upward sloping where the 10-year has a higher yield than 3-month. Then very soon after there's a recession, right? So it's the case that in all of these examples, and the ones you can see on the chart, but also going back further, the recession doesn't begin until after the yield curve is back in upward sloping territory. Okay, so the fact that some of us have been saying, hey, whoa, folks, the yield curve inverted, get ready, brace yourselves for impact. It's not so much that the yield curve has given a false signal right now. It's just normally it doesn't stay inverted this long. All right, so I'm not trying to make excuses for myself. I know in previous writings and maybe even things I've said on this podcast, I've certainly said on other podcasts talking about this stuff, when I was trying to give timetables for, based historically, once the yield curve inverts, how long before the recession begins? And I would go give the averages and stuff and, look at the longest lag was this and the shortest lag was this. And so if we're somewhere in the middle, blah, blah, blah. And those all ended up being premature because let's just say, for the sake of argument, that the yield curve does, in our time, go back to being normal and upward sloping, and then soon after a recession kicks in. Well, then still, look, from that point looking backward, the yield curve is still going to have a perfect track record, except for that one borderline false positive that I talked about. This will not be a counterexample if that were to happen. But what you would see is, and then if you ask, okay, now looking at all these past examples of when the yield curve inverted and then there was a recession, what was the lag between when it first inverted and then the subsequent start of the recession? This episode we're going through right now would be the longest, I believe. Okay, so that's partly what's going on here in terms of some of us who've been warning. It would have been more accurate and safer if we had said, historically, this is just to give you an idea of the timetable, but really the thing that's the true trigger that will let you know when it's really close is once the yield curve goes back to normal. And then we have a very short fuse, historically speaking, right? So that would have been more accurate guidance in hindsight's 2020. All this assumes that this pattern does still repeat itself and that it's not that this time is different, right? So what would clearly falsify the yield curve's track record is if it goes back to normal and then 3 years go by and there's no recession. Then clearly we would say, okay, this was a case where the yield curve was deeply inverted for a long time, then it went back to normal. Oops, no recession. So that would have been a false positive. But again, we don't know yet what's going to happen because it's still inverted. Incidentally, let me just mention in terms of the economics of it, what I think is actually going on. It's not that the yield curve's causing something, right? Obviously, it's that's a signal giving us indirect information about something else that's actually more fundamental. And so what I think happens in practice, it's not that the yield curve going back to normal makes a recession happen. Rather, I think what it is, it's more like during the boom periods, the central bank and the commercial banks are all pumping in money that's not corresponding to genuine real savings. So that pushes short-term interest rates artificially low and possibly pushes longer-term rates higher because of all the extra inflation expectations. So that's what makes the yield curve in a normal environment upward sloping, right? The short rates are pushed down, long rates, if anything, are pushed up by aggressive monetary policy. So that causes a bunch of unsustainable investments. The real structure of the economy, structure of production, becomes unsustainable, meaning a crash has to happen. Now, in terms of the timing, though, yes, money matters. And when the banking system takes its foot off the gas, the central bank gets worried about inflation, starts hiking its target policy rate and so on, then that sets in motion the changes that are leading to a crash. But it's actually a good thing. Like the system's going to get cleansed of the malinvestments and the economy will rearrange its resources and get on a more sustainable footing. But as that crash becomes more and more imminent in the presence of the high interest rates, so that's when the yield curve is inverted, is when the banking system tightens because they're trying to get inflation under control, by which I mean consumer price inflation. And so that's what all of a sudden, leads to the inconsistencies and entrepreneurs realize, we should not have expanded so aggressively, that now with interest rates being this high, our business model doesn't make sense, right? Lots of entrepreneurs are coming to that conclusion. And so a lot of projects that were started, the people running them realize either we shouldn't have started this at all, or we should have been more modest in what we were trying to do. So there's a bunch of unsustainable projects now in motion, and then them winding down, laying people off is what's going to be perceived as the onset of a recession, right? And several of those things are going to stop their flow of goods and services. So official GDP, the growth is either going to drop or actually will go negative. The flow of goods and services will be smaller than it was in prior quarters, and that's the recession. But I was saying the people running the central bank aren't complete idiots. They can see that coming too. They got all kinds of data coming in. And so to try to get ahead of that, to cushion the blow, they then start lowering rates. And again, they have more influence over short-term rates. And so that's why I think in practice, what you actually see is, there's a quote normal period with yield curves upward sloping. Then all of a sudden the yield curve inverts when the central bank and the banking system jacks up short-term interest rates, so they're temporarily higher than long rates. Then the economy starts showing signs of weakness. To try to avoid a recession, the central bank cuts short rates, so now the yield curve's back to normal. It's uninverted, but no, that's not enough. Too little, too late, and the crash happens. Okay, so the normal sort of Keynesian policy analysts and economists, I think, would just talk about, they didn't cut soon enough. Whereas from an Austrian perspective, say, no, the mistakes were made during the boom period. A crash was inevitable. You're just fiddling with the timing of it. But either way, that kind of explains the pattern. So it's not that the yield curve uninverting literally causes the economy to crash. Rather, I think it's more that given when the economy is really going to start to crash for physical reasons, if that's the way you want to talk about it, the central bank sees that coming and they start cutting short rates to try to stop that or to cushion the blow. And then that's what we see is the yield curve uninverting. So that's why the yield curve, given that the economy didn't crash, it's not surprising that the yield curve has remained inverted this long. Right? So I'm not really explaining why it was able to last this long, but I am saying, given that we haven't had a recession yet, that explains why the Fed didn't have to cut short rates, because inflation still has been higher than what they wanted. All right. So anyway, what it could be, I'm just throwing this out there. It might be something like, because they dumped in so much money during the COVID lockdowns, that put the economy on such a sugar high, and then coupled with all of the logistical problems and bottlenecks with the actual lockdowns, that then when they released those, that kind of just did this weird thing where there's all this money getting pumped in, and then the release of the supply bottlenecks and those two things interacting allowed the economy to limp along for much longer than it normally would have. And then given that, that's why the Fed was able to continue with the rates being held at 5.25 or whatever it was for much longer than it normally would before it would have to cut again. Could be something like that. Okay. Just two other quick points here as far as my view on the economic output, or outlook, I should say. The employment to population ratio, just flash that graph for you folks. You can see that's still, what this is showing is the percentage of the population itself that's working, that's employed, right? So this is different information from the unemployment rate. So the reason the unemployment rate can be misleading is that if people drop out of the labor force, they're not counted as unemployed anymore. So for some applications, the employment to population ratio is more informative, because it's just saying flat out, given this is how many people you got in your country, what proportion of them are working? Now, this isn't perfect because as the population ages, you might expect a decline in this figure. Okay. I don't just mean, of course, at any given time, take a snapshot and then look in 10 years later, all those people are either dead or 10 years older, right? We don't merely mean that. We mean the distribution of age cohorts. Okay. So when I say our society is aging, what I mean is the proportion of our population that's 60 years and older is higher now than it was 30 years ago, for example. All right. It has to do with falling mortality rates and falling birth rates. If you think of how those two would interact with each other, that would mean the population in general is getting older. That's partly why, by the way, Social Security and Medicare are in such deep holes, actuarially speaking. It's because there's not, as the population, it has to do too, like with the baby boomers coming through the pipeline, that it's our population distribution in terms of the age is getting more lopsided to the right. And that's given that we have a pay-go system for those entitlements, that's unsustainable, right? That each worker now is supporting more retirees than was the case 30 years ago. That's one way of looking at it. Okay. So back to the employment population ratio, you can see in this chart, it is, it fell off a cliff during COVID, which wasn't surprising because of the lockdowns. Then it recovered rapidly, but it never regained even the pre-pandemic level. And you can see it went up and then it's even fallen a little bit, right? So it's lower now than it was a year ago, right? So it's not just that, we're still gently recovering from COVID. It peaked and now it's going the wrong way for at least the last year as I record this. And then the other thing is, it's not just that we haven't recovered to the pre-pandemic level, it's that we're nowhere near the pre-financial crisis level, right? That the employment to population ratio fell off a cliff going into the financial crisis of 2008, and then it only very tepidly recovered over the years since bottoming out in 2010, and then it fell off a cliff again because of COVID. So the point being that the economy, the labor market, something is screwy that hasn't been right since at least the financial crisis hit. Again, some of this you could explain by the aging of the population, but these rapid falls, it's not like the population right now is much more tilted towards the elderly compared to what happened on the eve of COVID, right? That was only 4 years ago. So that can't explain too much of that secular fall. Okay, so where do we stand? Big picture, I still think we're in store for a bad recession. I think the Fed sees that coming now as more and more data come in that are going to confirm that. Because for a while, and I've written articles here. I think I had one last fall of 2023 at the infineo website. It's not just the inverted yield curve. Plenty of the leading economic indicators for an impending recession were flashing red. So it turned into, the mystery was, how come we don't have a recession? Like all these things are all pointing to there should be a recession. And it was kind of a mystery as to why is that? And of course, the pro-Biden people were all saying, it's because of his great policies and so on. And it's just Fox News doesn't like Biden. And it's just causing the average Americans to think they're doing poorly, but really they're doing great, that kind of stuff. So I think now that there's been this scare and people kind of come to their senses and the unemployment rate has continued to trend upward, triggering the Somme rule, I think the Fed is going to start cutting rates. Are they going to have an emergency meeting? I don't know, but that wouldn't shock me. And so I think the Fed is going to start cutting rates. I'm recording this right now in August 2024. I think you're going to see multiple rate cuts during this calendar year. That's going to cause the yield curve to uninvert. And then I think we're going to have a bad recession. And so again, once the dust settles looking backwards, the yield curve will still maintain its pristine track record. It just will say, well, that was a weird one where the yield curve was inverted for longer than in prior episodes. Okay, shifting gears, let's now talk about the idea of a Bitcoin reserve. So here on July 31st, 2024, Senator Cynthia Lummis of Wyoming, Republican, her office issued a press release and she had introduced legislation. So the bill is actually the boosting innovation, technology, and competitiveness through optimized investment nationwide, or Bitcoin Act, in the Senate. And among other things, it was going to instruct the Treasury/Fed to begin stockpiling a 1 million unit Bitcoin purchase program over a set period of time, so that eventually the U.S. authorities would have a stake of approximately 5% of the total Bitcoin supply. And they say that's kind of like what we're doing right now with gold reserves. And then they say this isn't going to require new funding. This is just going to diversify existing funds within the Federal Reserve and Treasury. And they emphasize, like, hey, we're not trying to mess with private holders of Bitcoin. We don't want your private keys. Go ahead and keep self-custodying. We're not messing with you. We're just saying we're going to do this as a government policy. Just like, you're allowed to own gold. You could have gold coins, whatever, but also the U.S. government has the largest gold reserves, at least according to the official statistics, on Earth. Okay. So what are my reactions to that? Big picture, I think it's a bad idea, but don't misunderstand me. Just because I don't think, I don't want the federal government, I don't want the Federal Reserve to exist. And then given that we're going to have a federal government with the Treasury and everything, I don't want them holding currency reserves either. Okay. So that's the sense in which, no, I don't want them doing this particular thing, because I don't even agree that they should exist as organizations, or even if they do, I don't want them having such programs, period, let alone us just quibbling about, okay, what kind of assets are they going to hold as reserves? Okay. Having said that, though, you're all right, yeah, fine, Mr. Purist Murphy, but let's just go with the sake of argument and say the existing institutions are going to be around for a while in their current form. Given that the Fed/Treasury are going to hold reserve assets, would it make sense to diversify their holdings, to reduce their holdings of, maybe they've got like swaps with euros and things like that, and we know they have a bunch of gold, maybe slightly reduce their holdings of those other assets in order to start bulking up their holdings of Bitcoin? So on that score, if that's the narrow way we're framing the problem, then yes, I agree that would be a good idea. Just as if I were talking to a private sector institutional fund manager who had a lot of assets, then, like Tether, for example, they have some Bitcoin holdings, and I think that makes perfect sense, right? It's not too much, right? Because if you're running something that, they're running a stable coin, like it's a US dollar denominated asset they're providing to their customers, what they have, in a sense, backing that up also has to primarily be very short duration dollar denominated assets that have an extremely low default rate or risk, right? And so that's why Tether is sitting on boatloads of T-bills. It does make sense, given their huge portfolio, to throw a Bitcoin into the mix. You have some gold and some other things too, just to give that kicker, to give a little bit of a hedge. All right. So in that same spirit, then, given that the U.S. authorities are issuing U.S. official dollars, that's their liability, and they're going to have assets on their balance sheet to kind of correspond to those outstanding liabilities, what should they have? Well, if we're talking about the Fed, it makes sense to have Treasury debt, right? But also, if it had a little bit of Bitcoin, that makes sense too. Now, again, in my view, we don't want public officials speculating. That's not their job. That's not their role, right? Because the incentives are all screwed up. So certainly it would not be, like, I think some people have the idea, probably Senator Lummis and some of the stuff Trump said too, and some of the Bitcoin fans who think this is a great idea. Like, look, we got this huge federal debt. Why don't we just take some tax money, go buy some Bitcoin, wait a few years for it to appreciate, and then pay down some of that debt? That'd be a very good investment from the taxpayers. But yes, it may be, but you don't want federal officials taxing you and investing the money and making speculative plays. No, they should give you a tax cut with that same money and let you do what you want. And then your private net worth will be higher. And then so hence that, coupled with your obligations in terms of the quota of federal debt that's yours proportionally, you'll be better able to deal with that. Okay, that is what I would say in terms of that logic. if for no other, either you think the Bitcoin thing is a good idea, if for no other reason, the slippery slope, that once you open the door and say, oh yeah, let's have Fed officials buy some Bitcoin is a speculative move. Okay, well, they could start buying all sorts of stuff and it just turns into, a sovereign wealth fund. And I don't think that's a good idea to give government officials that power. They're not going to just do it this one time to pay down the debt a little bit and then hand the keys back over. That's not going to happen. Okay, so having said all that, though, in general, what do I mean? Like, what's the function of having reserve currencies in the first place? So one thing is, and here we'll put up a chart, a government might want to literally peg its currency to another currency. Okay, so this chart here we're looking at is the US dollar exchange rate with the Chinese yuan. And you can see there's this flat line from, what is this? This is like the mid 90s all the way up through mid 2005, where it was stuck at around 8.2, 8.3. And so that was showing how many units of the Chinese currency did you have to get up to give $1. And then in 2005, under pressure from US officials, the Chinese let their currency strengthen against the dollar. So they broke the peg. But for a while there, for a good 10 years, they had that peg in place. So how do you maintain, if you're the Chinese authorities, how do you maintain that peg? You need to stockpile US dollar denominated assets so that you can credibly tell the currency markets, if our currency moves away from the peg, we can either buy or sell our currency against the US dollar, right? So it's easy. If the currency strengthens too much and they want to weaken it, it's easy enough for them just to create more yuan to buy more dollars, right? And they push up the yuan price of dollars, right? So if the exchange rate in the markets fell to 8 and they wanted to push it back up to 8.3, they could just create more yuan and buy more dollars with it, and that would push it back up. But what happens if it goes the other way? What if their currency weakens and the exchange, the market exchange rate goes from 8.3 to 8.4, 8.5, 8.6, and like, our currency's weakening against the dollar. We don't want it to be that weak. What do? Well, then that's when they can take their big stockpile of US treasuries, basically convert them into dollars, and then enter the foreign exchange market with dollars, saying, oh, here, I have a bunch of dollars. I want to buy some Chinese yuan. And so then that will make the yuan strengthen vis-a-vis the dollar, or makes the dollar weaken against it, whichever way you want to say it. Okay. And so then they can push the exchange rate from 8.4 to down to 8.3, back to 8.2 or whatever. All right. So that's the way it works. So in order for them to be able to play both sides of that, depending on which side of the fence it starts tipping over, yeah, they can just create Chinese yuan at will, but they can't just create US dollars at will. So for that, they need to have a big stockpile of fixed income US dollar assets. And so, as you may know, the Chinese authorities stockpiled massive amounts of US treasuries. Okay, so that's what's going on there. So you can see, if you ask, well, why would they want to have dollars at all? Well, that's partly why. If as a matter of policy, you want to literally peg your currency, or even just to say, we want our currency to be within a certain band in its exchange rate with this other currency. And you might do that for reasons of prestige or managing trade flows, right? Other things equal. If your currency weakens, that promotes exports. If your currency strengthens, that encourages imports, and so on, right? So there's all sorts of reasons that a central bank might want to have some control over its currency's exchange rate with another, particularly if, a country like China that has a large production capacity, but not as well developed financial markets. And so I think, especially in the early and mid 2000s, late 90s through the mid 2000s, they wanted to reassure international investors about the safety of investing in yuan-denominated or renminbi. I never remember exactly when to use one term versus the other. It's like the British pound versus sterling. It's analogous to that. Assets denominated in the Chinese currency, right? And so as an investor, if you're, in the Eurozone or the United States or Great Britain, you are concerned about if you invest in Chinese Chinese currency denominated assets, what happens if the exchange rate moves on me? Okay. And so to allay such fears, the Chinese authorities are saying, no, we are pegged to the dollar. And this is a credible peg because look we're stockpiling all these, hundreds of billions of dollars of treasuries to show that if our currency does start weakening and we're losing our grip on the peg, we can just come in to the Forex markets with all these dollars to maintain the peg. That's kind of the idea. All right. So in that context, it's clear, this is why as a central bank, you would want to have a bunch of different holdings of assets denominated in other currencies that you care about. But more generally, this is the last point I'll make here for our episode, is even in the modern era of fiat money, it still makes sense that the central banks would want to have other assets, in a sense, backing up their currencies. Not because there's literally going to be a redemption request because you can't redeem it for anything, right? So just to remind you, the historical context, back in the day, the central banks, the notes they issued, which were their national currencies, were redeemable in gold. Before World War I, all the major powers, their currencies had defined redemption rates in terms of physical weight of gold, right? The French franc, Italian lira, British pound, US dollar, those all were redeemable by anybody, even, regular citizens, not just other central banks, could go to, you go to the Bank of England and turn in your pounds and get a certain amount of gold. You go to the Federal Reserve, well, before 1913, there was no Fed, but you go to the US authorities, you turn in dollars, you get a certain amount of gold, so forth. And so there, it's crystal clear, why would they need stockpiles of gold to maintain that peg, if that's the way you want to call it, or if that's the word you want to call it, okay? But even after Bretton Woods, when the other central banks really were just on a dollar standard, and then after 1971, when the dollar was completely severed from gold, and they're all fiat currencies now, just floating, you might say, so then why do they need to have any kind of reserve asset at all? Well, because still the public can get upset if domestic consumer price inflation gets out of hand. All right, if the central bank is issuing too much currency that's causing regular retail prices to rise more rapidly than the public is willing to tolerate, how does the central bank reverse that? Well, it needs to suck money out of the system. So how do they do that? Well, if they have assets, they can sell off for money, and then they just destroy the money, right? It's just the accounting flip side. How did the money get into the system? The central banks don't just print up money and do a helicopter drop as a gift. No, they're banks. They buy assets with this newly created money. That's the method by which the new money is created and injected into the possession of other members of the society, is the central bank goes out and buys assets from them for newly created money. It's a nice gig if you can get it, right? You can see why when people like Ron Paul say, "end the Fed," the whole intelligentsia class comes in. Oh, that's crazy. Like, it's the central bank is a very powerful engine, and a lot of powerful people want to keep that thing going. Okay, so they create money in the act of them buying assets. So that's where the new base money comes from. And again, if they overdo it, then prices start rising too rapidly. People get upset. So if they want to at least partially undo that, what do? They sell off some of their assets to suck that money out of the system and effectively destroy it. And then that takes, away inflationary pressures or reduces it. So the problem is, what if you buy an asset that then falls in value? Well, then they can't completely undo their original inflation, right? So if the Fed created $1 trillion new and bought my old pickup truck for $1 trillion, writes me a check, and I put it in my bank, and it's good because the Fed wrote it, and my checking account balance goes up by $1 trillion, and now the Fed has added Bob's pickup truck to its balance sheet, the asset side. That could happen. I mean, that probably violates some statutory authority, but economically that could happen in terms of bookkeeping. But then I go out and I start spending the $1 trillion, it makes its way around, to other people's accounts in their respective commercial banks and whatever, and reserves of all those banks are way higher, and maybe they make some more loans on top of that. So there's a lot more dollars, both in terms of base money and then M1 in the system. So the U.S. price level starts rising more rapidly than it otherwise would have. And people say, whoa, 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 we got to shrink the Fed's balance sheet. And so the Fed can say, oh yeah, how about we bring our assets down by $1 trillion? Let's sell Bob's pickup truck back and suck $1 trillion. Well, no, it can't, because nobody's paying the Fed $1 trillion for a pickup truck. Okay, so the Fed on its books would have to acknowledge, oh yeah, there was a big loss on that asset. And now they literally can't suck that money out of the system. Okay, I'm picking an exaggerated, absurd example to make the point. More realistically, what could happen? Well, what if the Fed comes in and buys a bunch of treasuries when interest rates are really low? Buys trillions of dollars of treasuries when interest rates are low. Then, price inflation's high. The Fed jacks up interest rates, and now the value of its assets has a huge capital loss. And if the Fed tried to completely reverse all of the inflation that it pumped in during the COVID crisis and just sold off all those treasuries to suck dollars out of the system, there'd be a mismatch. The Fed would not be able to sell all those treasuries right now at their current market prices for what it paid for them. And so there would be an overhang where there'd be a bunch of excess dollars that were still out in the system that the Fed would no longer be able to suck back. Okay, so that's partly why, just as a matter of policy, you would want your central bank, given that it's going to exist and be running operations, you don't want it to go insolvent for sure. But the Fed right now is technically insolvent. Okay, so that's one reason you might want them to have a little kicker in there of some Bitcoin, is that in a certain situation, just like anybody who's managing assets might want to have some in there, that even the Fed being caught flat-footed in the face of a massive crash in the dollar, for example, other things equal, the Fed would be in a stronger position to respond if its own assets consisted of things besides treasuries, right? If the dollar were to crash, sitting on a bunch of treasuries doesn't leave you sitting pretty.